Hey mom, how you doing?
I am having a fantastic day, Lindsay. I will tell you, a day of podcasting is a pretty amazing day for me. I'm glad that I got to spend most of my day with you. I hope that you are having a good day as well.
I am. I am. Thank you. Getting a lot done. I am going through the trials of learning some agency focus things today, though. I will tell you what. So I am becoming an agency focus expert today, getting all my
Music
training
to
in.
my ears, my friend. Music to my ears. I love it. Well, I'm super excited. I get to meet some of the most incredible people as I travel all around this country of ours, and I get to do some things that I love. And our guest today is among one of those people that I got to meet and I've maintained a friendship with for a period of time because we connected on all kinds of different ways. So, Kimberly Bunce of Security Financial Bank, that's located in Wisconsin, please welcome to the show, my friend.
Thank you so much. It's so good to see you. So good to meet Lindsay. And
Yeah.
want to congratulate Lindsay right away on her recent wedding. That's super
Thank
cool.
you. Thank you. Our
Yeah.
podcast listeners have heard probably way more about my wedding than they ever want to, but it was an awesome, like, long weekend. We had so many fun activities planned. And after getting all of those people to all of those activities that I planned for them, I'll tell you what, I'm ready to not migrate people around a foreign country for a very long time. That was a lot, but I wouldn't change anything for the world. It was so fun.
That's
I will
excellent.
tell
Well,
you
once in a
this.
lifetime, right? Once in a
Yeah.
Right.
lifetime, at least that's the goal. That's the plan and the hope.
Yes.
That's right. So, Kimberly, I'll share a really quick story with you. Lindsay got married in Charleston. We went to France, but then she had a day where just her bridal party, her, Patrick, and their bridal party went out and they went to lunch. They did whatever. And they thought it would be a really good idea to take those green scooters up to a hill that we could see from our hotel, at pretty high speeds with no pads the day before the wedding that we planned in France. I mean, and as I'm, like, I don't know what she's doing with her bridal party and whatever. And then when I see some of the pictures that she sent to me, I'm like, you do realize we all flew here and you're going to look really bad if you've got like, this, what do you call that, road
Like
rash
road
all over
rash.
you because it's warm, they're in shorts and like tank tops and whatever. I'm
Oof.
like, I don't know that this was the best idea on the planet, but
Yeah.
everybody came out unscathed. But it's kind of funny how you don't think about the things until you're in the middle of it. You're like, oh, yikes, that could have gone the wrong
Yeah.
way. Yeah.
Well,
Yes.
I wasn't drinking at lunch. I was just like nervous, right? And so I was like, you know what? I don't really need to like add alcohol on top of this. And I forgot the fact that the rest of the group that we were with was drinking. Like they had been drinking a lot. And so we are riding these Lime scooters like on the road, right? When you're in Europe, there's scooters everywhere and it's kind of chaos. So we're part of that chaos and going up the to this like beautiful church. Our Lime bikes told us that we rode over 20 kilometers that day, which is far, I think. And we topped out at like 35 miles an hour on like a Lime scooter. Not the scooter, the not like a scooter like a motorcycle, but like a pedal your foot type of like
Yeah.
electric one. Yeah. So we're coming down
Yeah.
and we're at like the last light before we get to the hotel. And I thought to myself, it occurred to me in that moment as we were done that all of them had been drinking because they were like, do you want to, like, anyone want to go get more drinks? And I was like, you guys have
This is
already
a bad
drank a lot.
idea. This is a real bad idea.
Yeah,
Yeah.
so that one was a little bit of a crazy moment, but no one got hurt. No, nothing happened. So it was fine. It was fun.
And now you've got a good story,
Exactly.
Exactly.
among
Yeah.
others. Yeah.
Exactly. Yeah. Fun
So,
times.
yeah. So, Kimberly, we've known each other for a while, but there's people in this industry that might be like, I don't know who Kimberly is. Let's give them a little bit of background. Who are you? How are you connected to the insurance industry? And just a little bit about you.
Okay, sure. Well, and it's kind of fun that I've become connected to the insurance industry because I'll start by sharing that when I was in high school, I was probably a sophomore or junior in high school when my father started talking to me about I should really get into insurance. He thought I'd be really good at it. He has no insurance background, but he had friends in the industry, and he thought it would be a really good industry. He thought with my skills, that would be a great industry for me. And as a young high school student, I thought, insurance, that doesn't sound exciting. Why would I do something like that? So instead, I went to school and I majored in accounting as if that's really exciting. But I
Hey man,
became
don't knock us. Yeah, don't knock it, man.
Yes, I know. So I went to school for accounting and I worked as a CPA for about 10 years and then I switched into sales because what I really love is dealing with and working with people. And so I was in sales in a few different industries, initially telecommunications industry, which I liked. And then I went into media sales for a short time, not really my forte, my strong suit. And then I had a job in the fitness industry selling commercial grade fitness equipment. And that's my passion. Really loved that, but got a little tired of the travel. So I ended up coming to work for Security Financial Bank, which is a local community bank, where I thought I could use the two different skill sets, the numbers part from the CPA days, and then the relationship part from the selling days. And after joining the bank about 5.5 years ago, I was immediately invited to join what we call our Big I team, which is we have an insurance niche, lending niche. It's written right into our loan policy, a separate section where we like to finance insurance agencies. And as part of that, early on, I don't think I'd been with the bank real long, maybe a year or so, by the time we got introduced to Carey at one of the state conferences. Flew her here to town to give us some more training. So we got educated on this industry. We really wanted to go all in if we were to go into this industry. We initially were informed of this industry by a former board chair. The chairman of our board, maybe 10 years ago, is a local CPA who works with a lot of insurance agents, and he was the one that said, you really should give this industry a look. A lot of banks refuse to lend to insurance agencies because there's no tangible collateral. They don't understand it. They think that it's risky. So he convinced us with the constant revenue streams, the strong cash flows, retention, that we should look at it. So we started educating ourselves, and Carey, among others in the industry, came to give us education, and then we joined all the state trade organizations for Wisconsin and Minnesota and keep getting as much education and soaking in as much information as we can on this industry. So,
Yeah.
Love it. Love it.
yeah.
Love it. Love it. So I guess since that time, as you've learned about the industry, what are you seeing from a banking perspective happen given the fact that the market's shifted? When we first met, we were not in a hard market. I don't even think I
Mm-hmm.
used the term hard market one
Right.
time in our presentation.
No.
So we have a hard market. We've got a different interest rate environment at the time. I think might have been the lowest interest rates the industry had seen in a while.
Correct.
So give me an idea of what that looks like from your perspective, from the banking perspective.
Sure. For the banking perspective, I would say initially getting into this industry, and I didn't know what a hard market was. I remember the first time that somebody mentioned a hard market, I had to inquire, what does that even mean? What is a hard
Yeah.
market in the insurance industry? But what I did notice was initially we were quite active with requests, with financing requests for either acquisitions, partner buyouts, and it has slowed down. Of course, interest rates impact that quite a bit. And it was really fun as a lender when I could offer people those 3% rates. That was a lot of fun.
Yeah, of
Mhm.
course.
Yeah, for refinances or just even for initial loans. As the rates have crept up, we have noticed a real slowdown. Even though I hear that M&A activity is up, we as a bank have really noticed a slowdown in the last year for sure, maybe even a little bit longer, with financing requests. And I think that's partially because of the higher interest rates. And I think that has led buyers and borrowers to maybe seek financing other ways, like either through seller financing, or maybe there's more internal succession plans, perpetuations, rather than selling externally, which lends itself more to like a seller financing kind of arrangement. And then the other thing I'm thinking, I'd be really curious to see what the two of you say about this. Um, if the M&A activity that I hear of has really stayed active increased, if that's more on the private equity side than it is on the, mom and pop agency buying another agency where they might seek financing or partial bank financing, because we really have We really have seen a slowdown. And I think sometimes some sellers or buyers are feeling the stress of the hard market, the rewrites, just the busyness. And maybe they're a little bit leery right now of taking on a new agency on top of
Yeah.
everything else they've been dealing
Yeah.
with this hard market. I don't know.
Yeah. So I think, Kimberly, I don't see the same, but my footprint is a bit wider and it's,
Yeah.
and I think there's pockets around the country that'll see peaks and valleys. But I agree with you, though. I think the increased interest rates have caused some agencies to say, well, I want to command a certain price and therefore I might hold out and I might wait until I think that I can get the price that I want. Or it's forced them into, I will hold the note or I'll hold part of a note where I wouldn't be as, I wouldn't contemplate seller financing when it's the interest rate's 3. Like it doesn't make any sense. So I think it's
Hmm.
forced some people to change the structure of how they're willing to sell, because nobody wants to sell their agency less than what they think it's worth. And the multiples have increased over time. So if the interest rate environment causes that multiple to go down or that price to go down, they're going to find another way to get what they think it's worth or just wait. Here's the thing I truly think is I don't think it'll continue to slow down or really, really slow down until multiples come down. Like I think that something has to happen in the industry because there's still so many people that are facing retirement. They're
Hmm.
aging demographic along with the changes that and the pressure that's being created in our industry is going to continue to cause people to think now might be my high. So for instance, the surge of AI and operating efficiently, the agencies that are adapting and really adopting those things, allowing their agencies to have more capacity, utilizing technology, are going to be in a position to buy more. And those that aren't going to be able to command profitability, aren't going to be able to meet the needs of their customers in the same way. Therefore, their agency's growth will start to slow and the value of their agency might stay flat or decline. So, you know what I mean? I think it's just creating who's going to be the acquirer and who's going to be acquired. But given the demographic, the number of agencies and the number of small agencies, I just don't think it's going to completely go away just by one factor. I think there's many factors that are causing you to decide whether this is your time or not your time. Does that make sense?
It makes total sense. And there's a lot of parallels with what you just said with acquisitions, with the insurance industry and agencies, as with the banking industry.
Yeah.
Same
Yeah.
ideas. Growth is necessary, staying up with your technology, all of that. It's really interesting, all the parallels there.
Yeah.
Yeah.
So yeah,
I
and it's
think
just
we're
to me,
also
it's
seeing a super interesting thing with growth right now too, though. Someone just did a LinkedIn post and there were a bunch of agents in the comments saying, I hadn't thought about this, I need to look at it. But with rates having been up so high, if you're not keeping a super close look, if you're almost like a lifestyle agency that you're not deep in your data every single day, keeping track of what's going on, your agency could show that you have high growth, but it's just rate. And so when rates come back down, that's going to reflect in the size of your agency. So for some agencies, I think this is their high. Like, I think that is
Yeah.
a really real risk that is happening out there that people aren't paying attention to quite yet.
I
Yeah.
agree. We as a bank too, when we do receive financials from agencies, I mean, we would expect there to be revenue increases just due to the premium
Just due to
increases.
rate,
I mean, that's
right?
yes, that's just due to rate, and we expect to see above and beyond that for a healthy agency to show that they're growing, organically and that they're retaining customers and gaining new customers rather than just increasing the revenues based on rate.
Yeah.
Yeah.
So,
Well, you led me right where I was going to go. It's almost like you can read my mind. So, for those that are seeking funding or seeking financing, I often hear like, can I get pre-approved? How do I prepare? What should I know? Because those people that have never acquired before, they're going through it for the first time and they might not really understand what do I need to do and how do I make sure I don't slow it down as the buyer because I'm
mhm.
unprepared. So maybe you can either say, how do you prepare? Or what are some examples that has slowed it down and how do you avoid some of those things? Like what's your viewpoint from the bank's perspective?
Yeah, well, one thing we would say is that it's important for agencies to maintain and have quality financial statements, and also understand their financial statements. Preparing their balance sheet, for example, retaining cash, building assets in their existing business, examine any concentrations they have, diversify as much as possible between personal and commercial lines, watch concentration levels in any one given industry. For example, if you've got 75% commercial lines and over the road truck drivers, or something like that. Do you have any areas of overhead that need some reexamination? What are your long-term goals? Some of those things. We request financials. I know for valuation purposes, I believe you and others might ask for 5-year historical financials. We as a bank will look 3 years back, but we'll ask for, 3 years company balance sheet, income statements, tax returns, and that's both for the agency and personal tax returns, personal income statement for the individual, because in most cases we'll require a personal guarantee for any loans. But I think the bottom line is for agencies to understand that maintaining good financials, a strong balance sheet, understanding their financials is pretty key when it comes to wanting to acquire and get approved for a loan from a
Yeah.
financial institution.
So give me an idea when you say will require a personal guarantee. What does that mean, and what are the situations where you do require it? What are the situations where you don't require it? Because I
Sure.
think sometimes there's a misunderstanding, like your personal financials actually matter too. Like that's
Yes.
important.
Yep.
So
They do. They do. So the borrower would typically be the entity. And you said in the situations that we would or wouldn't require a personal guarantee, I would probably say fairly 99% of the time we would require a personal guarantee. So the
gotcha.
borrower is the entity, the corporation or the LLC, and then the borrower is expected to repay the loan amounts. And if ever the borrower was not making those payments, the personal guarantee would then flip over to that individual that would be responsible for making those loan payments. So we ask that the agency owner personally guarantee their note to us, because we would expect that if we're trusting the company to pay back the note, they should at least have some skin in the game, and they too should attest to the fact that their entity, their business, will be paying back that note.
Yeah. So as a buyer, if you have this impression that I have all my company financials, but maybe personally it doesn't look so hot, like maybe I
Mm-hmm.
have a lot of debt, it could slow it down. Like you really have to make sure your own personal financial situation is strong as well. Correct?
Correct. Yep. And we
Yeah.
even will pull credit report on our guarantors to make sure that their credit score is at least,
Mhm.
I don't know what exactly our minimum is. It might be 650, 680 or something. But I mean, we check credit reports. We want to make sure that they have a history of good credit.
Yep. Important. It's not just your company. So, I think
Mm-hmm.
if you're a first time, buyer, you might not realize that, and you might be surprised by that. So being prepared can definitely help. What are some
Right.
things that you've seen in deals that either sped it up, made it go really, really well, or slowed it down? Can you give me some examples of what that looks like?
Sure. Well, what makes it go really, really well is when, we make the request for the certain financials and they send them immediately to us. We start with an insurance agency questionnaire that asks questions such as how many producers, how many total staff, top 10 carriers, the mix of personal versus commercial lines, top 10 customers. We're just looking for concentration. So we have a very little do our own initial mini, not evaluation, but just an assessment of the agency to start with. So things that make it go well would be just collecting all the information timely. They provide a purchase agreement. They have all the information, which we always recommend that they have a purchase agreement drafted by an attorney and that they talk with an attorney related to such a transaction. So in the best possible case scenario, all of that stuff comes in, it all looks clean, it all looks good. Things that'll sometimes slow it down. We've run into situations where there maybe are credit issues on the personal side, which that definitely slows things down, whether it be late payments, a history of late payments, bankruptcies in the background, if it's been within the last few years. Some of those things can slow it down. Sometimes what slows it down is not being able to get quality financials, more often from the company that's being acquired, which surprises me, because to me, the buyer would have done their due diligence on this company well before even considering acquiring the company. But sometimes, we'll ask for that insurance agency questionnaire to be filled out both for the buying agency and the agency that they're buying. And oftentimes it seems that the buyer has a hard time accessing the information, which
Hmm.
to me, if I was a buyer and couldn't really get a good understanding of the entity I was buying, I
I'd be
wouldn't.
nervous.
Kind
Yeah,
of a red
yeah,
Yeah.
flag, right? Yeah,
right,
So,
absolutely.
right.
at what point in the process, Kimberly, should an agency reach out to you? Because, they're talking price. Do you help on what price they should be paying, or do you just come in at the end and say, "Here's your loan"?
Yep, that's
Where do they come to you in the process?
right. Very good question. We do get asked often to help with the price. We do not offer advice in that area at all. We might be able to share what we've seen. What's interesting to me is that the agents more often seem to talk about multiples of revenue. What we care more about and what we like to talk about and see is a multiple of EBITDA, which I know too with the valuations that you guys perform.
Hmm.
Some people will look at both, but what the more accurate indicator of an agency's value in our mind is that multiple of EBITDA. But at any conferences I go to, any trade shows, anything that I go to, you talk to the agents, and it's all about the revenue multiplier. What's the revenue multiplier? What's the revenue multiplier? So we do not give any of that kind of advice. I think we'd get ourselves into trouble trying to do so. So ideally, they have that worked out or they'll work that out. And as far as when they come to us, the earlier on in the process, the better. We don't mind if they come to us and they don't yet have the purchase price worked out. The sooner we can get involved, learn a little bit about the two agencies, the better as far as we're concerned. The hard part about that is it seems within the industry, it's kept pretty quiet. People selling their agency rather than advertising, hey, I'm looking for buyers, it seems like it's kept pretty quiet. And that's why referrals are hard because I feel like oftentimes we don't hear about it until after the
Yeah,
fact, until the
yeah.
financing has already been arranged. And
Yeah, that makes
Sure.
sense.
Well,
What
there's
about?
there's some there's some fear. There's fear that if people know that I'm contemplating selling, that I might lose some clients, I might lose some carrier appointments, I might lose some staff, and they don't want that because all those things would cause the value of their agency to go down. So there is this cloak of silence, and unfortunately, I think there's some agencies that because of that, because they won't put that out there, and rightfully so, like I totally understand it, they also may only speak to a small handful of people and therefore not get the best deal or explore all the options that they should be thinking about. It's kind of like a foregone conclusion if that's the way you're going to go. And it's super interesting. That multiple of revenue thing, though, I got to tell you, if there's two things I'd love to change in this industry. Number one, know your operating profit and what you can control
mhm,
that drives the value of your agency. Please, Lord, know your EBITDA. I know that it's
yes,
weird, it's a weird acronym, but please, like, it's under your control. And number two, have a perpetuation plan. Do not put yourself in a position that you're going to sell at a discount. If those two things I could fix, I would be and stop talking as a multiple of revenue, like every agency at a certain level is the same value. Nothing could be further than the truth. So anyway, I'll get off my
agreed.
soapbox. I get it, but it makes me
No,
crazy.
it's a good soapbox to be in, I think, because I agree. And we are surprised at how many agencies we are running into that don't have a perpetuation plan.
Yeah.
That to me
Yeah.
just really, really shocks
Yeah.
me.
I was on a call the other day with an agency looking to internally perpetuate, and one of the people who's getting perpetuated to said, "This is just getting really tough because every time I bring it up, having a perpetuation plan like brought up, I'm told that I'm selfish because no one really has that and you just want something in writing." And that broke my heart because you have to have a perpetuation plan in these times. We are the ones who get the call that someone's in the hospital. Hey, someone passed away unexpectedly. And it's
Right.
a scramble. It is absolutely a scramble at that point to figure it out. And you're already such at heightened emotions. There is
Yes.
absolutely no reason to not have a perpetuation plan in place just in case of the unthinkable happening. But
Sad.
it,
Super
it
sad
is
when that
really
Absolutely.
happens.
sad.
It
Yeah.
is sad. Well, none of us are guaranteed tomorrow. And even with some of these younger agency owners, I've heard some of them, I mean, it's never too soon to implement your
Yes,
perpetuation plan. And I've heard some
Absolutely.
younger agents that, may have two kids. Oh, well, I don't know. My kids are 3 and 5, and I'm hoping one of them might want to get into the industry. To me, that's just very risky and a little bit short-sighted because maybe they will. And if
Absolutely.
they will, then you might pivot and adjust your perpetuation plan. But I think it's always important at every stage in the game to have that perpetuation plan in place. One thing you
agreed.
just said, Carrie, reminded me as far as some snags along the way when you were talking about carrier appointments and, the risk of losing a carrier appointment. That is one thing we've run into just a little bit with an agency acquiring another agency that has an appointment that they don't have. They're in a market with whatever company, assuming that they'll be able then to continue that after the acquisition and learning that carrier isn't going to keep that contract. We have
Yeah,
seen that. We've
yeah.
also seen an individual who's very deeply ingrained in this industry, left one aggregator to start his own aggregator business. And the timing was just so unfortunate because it happened to be at the time when the hard market started, and he wasn't
Oh,
able to get carrier appointments. And so he's had to pivot and now has gone to work for another agency. The whole getting carrier appointments and keeping them,
Yeah.
that
yeah,
can create some snags. And we as a bank, along with that agency questionnaire we asked them to complete to begin with, we want to know their top 10 carriers because, we want to know if they were 90% secure a personal line.
right, right.
There are, and we try to stay abreast of the industry to the best that we can. We don't know all the ins and outs of all the carriers, but we do know concentrations are risky, and for that very reason, because you don't know when a
Yeah,
carrier might pull out
yeah.
areas of personal lines.
It used to be a strategy that would be a target to say, hey, I'll pay a premium for an agency that has an appointment that I would like to have. But in this market, without doing your due diligence, you could be buying a book roll. You could
Hmm.
literally buy something that you can't predict the ongoing value of it because you don't know the commission rates and that you actually bought a body of work that's beyond what you actually thought you were buying if you don't get that carrier appointment. So, and sadly, I just saw a Twitter post about that. Like, hey, if you want something, go buy an agency that has it. And, it's funny, below it were a whole bunch of comments of saying, well, you better check first. You better be in your LOI and it better be a term of the agreement because you better do your due diligence prior or else you could be making a really big mistake there. So
Yes.
I agree.
Hmm.
That used to be, and when people go based on, hey, I know so and so and they sold their agency for X times revenue, which drives me nuts. They also talk about when they got the contract of X, and it's not working that way anymore. Like it's a
Right.
really bad assumption to say what happened 5 years ago is what's going to happen today,
It is.
So
Yeah.
So
not a
anyway,
given that carrier
no,
appointment is going to come automatically
Nope.
with
no,
that
Not at
acquisition.
all.
Yeah. Yeah.
Or it's not even a given that a network membership is going to come with it either. They can deny
that's right.
like an incoming agency, or they can deny an agency moving their codes out. If your partnership with a carrier is through a network, the network at times, depending on your contract, can keep that book.
Yeah,
Oh, interesting.
Yeah. So
yeah.
there's a lot of, strange things. That's some of the items that we look into when we do buy side or sell side consulting to help agencies try to figure that out ahead of the game.
Mm-hmm.
So
Mm-hmm.
it doesn't get to you, hopefully, Kimberly.
Right, right. Correct, correct. So we are
So
talking about multipliers. Do you feel that the multipliers are at an all-time high right now or no?
I think they're actually flat where they were last year to this year. So I don't know. Nobody has a crystal ball. I really would love to have that crystal ball.
Mm-hmm.
They've definitely historically been rising. Here's my answer. I think multiples for well run agencies will continue to climb because I think well run agencies are going to find higher profitability, higher predictability if they make the investments in technology and efficiency and maybe some automation. I think that you're going to see those become a different multiple than a lifestyle agency that's not innovating. So I think it depends on what kind of agency you are, what the multiple is going to be. Interest rates rising actually caused buyers to be far more diligent in their due diligence. Like they are asking more questions. They're not just applying across the board. Everybody gets an X multiple. They're really digging in because the cost of money went up and they want to make sure that they get their return. So I don't think multiples are going to be across the board the same, but I do think those well-run agencies will continue to command nice multiples, and those that are not well-run will start to decline, flatten, or see some different situations. So that's my attitude about it. Not a one-size-fits-all industry at all. Yeah.
Well, for sure. Well, I liked your positive attitude about the positive side of interest rates rising.
Yeah. Yeah. See, listen, I'm here for
Causing
you
them
though.
to be more, yes, I like that. I appreciate that.
That's super
And
funny.
speaking of that, speaking with interest rates rising, I would say, of course, we as a bank look at cash flows and debt service coverage ratios and those kinds of things. And so, if ever with an acquisition, one agency is trying to acquire another and they're not going to cash flow, well, that tells us one of two things: they're probably paying too much for that
Yep.
agency. But as
Yep.
far as the higher rates, we haven't really done a lot to structure our loans any differently. One thing that we have done on a limited basis is maybe for the first couple of years. I mean, ideally, if two agencies are merging, somebody's acquiring another agency, expenses should be able to be cut a little bit and some of those kinds of things, but sometimes not initially. Or maybe the seller is going to stay on for the first year or two and still draw a salary. So one thing that we maybe will do is, instead of an amortization of, say, 7 years or 10 years, maybe we'll amortize that note initially, the first 3 years on a 10-year amortization, and then we'll re-amortize it
Yeah.
after that at 4 years. That might be one thing we can do to try to help out. And we try to be creative, to help with cash flow if it makes sense, but that's completely understanding why the cash flow may be a little tighter in those early years. Not that they've completely overpaid for an agency that isn't worth the
Yeah.
asking price.
Yeah.
So
So
getting
we were
someone
doing
involved that can project it out is really important in that case, Kimberly, because
Mhm.
there's lots of cases where maybe 2 locations is going to go to 1, but not until year 3. Or maybe, you definitely said certain people are going to stay on staff in order to retain the book and may have a smooth transition, but that's not going to be that way for beyond 2 years. Really important to have the ability to project that out from a buyer and seller standpoint, because you don't want to leave money on the table, but you also don't want to overextend and just think the way that pro forma looks is the way it's going to look forever. That's a bad assumption. So yeah.
Yeah.
Anyway.
Exactly. When I said we take 3-year historical data, we also ask for projection then as well.
Yeah, of course.
We were doing some staff training, and one of the things the projections that we put together, and one of the things we were talking about was when you go to a bank in order to get a loan, the bank will only cover, what was the rule, Mom? I'm
So
definitely gonna butcher it if I say it.
the thing that she's trying to say is they only let you use 75% of the profit in order to service the debt. So they're not going to let you say, here's the projected profitability of the combined entity. Oh, you can use every single dollar to pay the loan off. Like that is not the way that happens, because the bank wants to make sure if there's something that is unexpected, there's still profitability to be able to react to that. So that's what she's talking.
Exactly. Yeah, the bank
Yeah.
likes to see a little cushion, like on a debt service coverage or cash flow, rather than just an exactly 1 times coverage ratio. We'd like to see 1.2 times.
Yeah.
Yeah.
So is
Yes.
that's the same across all industry of banking, right? That's not like a preferred number at each bank.
So is that something you said, or is that all banks loan that way?
That's the way that all banks
All
loan. And
banks.
that's not just
Okay.
specific to, that's not specific to a bank. That's not specific to an industry. That's just in general for businesses that
Yeah.
banks want to see that cushion.
Understood. Got it.
Yes.
Yeah.
I
And
found
so,
that super interesting.
if an agency is
Mhm.
doing it on their own, they might say, hey, listen, I'm expecting, $500,000 of profit when I buy this agency, and the loan is only $495, a month or a year. I should be good to go, right, Carey? I'm like, no bank's going to loan for that. Like they don't
Right.
understand that's not a big enough cushion. And why would you want that? That's risky as a buyer to be that tight. because you better
Mm-hmm.
be real sure of everything that's in your P&L at that point, right?
Yes.
So
Yes.
anyway.
One thing though, that's for the cash flow side. When it comes to collateral though, and banks look at collateral too to make sure that they're adequately covered when it comes to collateral. And that's the precise reason that a lot of banks won't lend to insurance agencies, because banks look at the balance sheet and they say, what is there? They want something they can touch, feel, taste, smell, tangible collateral. And that's not the case with insurance agencies. But that was part of our whole education process and understanding the constant revenue streams and the cash flow and all of that, so that we're comfortable lending to agencies. And we don't require SBA, we don't, but what I was going to say is, as far as the collateral goes, whereas if a business was just going out and buy a piece of real estate, so let's say that piece of real estate costs $500,000. Now the bank isn't going to lend them $500,000. They're going to have a down payment, which might be 25%, and that's how the borrowers talk. How much will I have to use for my down payment? The way we bankers talk is what we'll provide as an advance rate. So we say we'll advance 75% of the value, the lower of 75% of the appraised value or the cost. So anyway, so they're limited that way to not get 100% financing. Whereas in most cases on the insurance agency side, because there's the value of the buying agency and then they're buying another agency, we will combine those two agencies and then lend up to 75% of the combined value. Almost all cases, they can get 100% financing to cover the purchase price of the agency that they're buying. So that's one little advantage that agencies see in this industry as opposed to other businesses. I don't know if you guys can hear it in the background. Here in Eau Claire, Wisconsin, we're having a little thunderstorm right now.
Understood. We live in the South, so we get it.
Yes.
Yesterday, it was storming so bad here that I was getting like lightning notifications on my phone, like,
really?
seek shelter, there is so much lightning. So we completely understand in the summer, but.
Well, hopefully this will take away a little of our humidity, because truly on my way to work today, I couldn't see out of my side view mirrors because there's so much condensation on them. It was that thick.
Yeah, totally understand. Well, Kimberly, it has been great to have you on. I've learned a lot on this podcast, and I hope our listeners have too. I feel like there was a lot of little like tidbits of information in there that could be really helpful to an agency looking to buy other agencies. So thank you for coming on and sharing with our audience, and we'll have to have you on sometime.
I would love that. Thank you so much. It was all a pleasure for me. I appreciate it. It was really nice to talk with both of you.
Yeah. Thanks so much.